Garage Gang, it's Thursday night in the garage. And if your portfolio feels like it just got shoved into a washing machine on Violent, congratulations, you're not crazy. Before we go any further, smash the like, hit follow, and share this with the friend who panic sold the bottom and immediately tweeted, "Markets are rigged." We see you. Now here's the setup. Triple X is out tonight. The man's at a Christmas party pretending he likes eggnog. Lulu's busy welcoming new members to the herd, so it's just me at the desk. Same garage, same standards, less patience. And tonight matters, because what happened today wasn't chaos, it was mechanics. Crypto didn't break. TradFi didn't win. And if you think CPI magically fixed everything, I've got a bridge to sell you. Comes with leverage. Stick with me, because by the end of this, you'll understand exactly who got forced, who quietly accumulated, and why tomorrow actually matters. Let's get into it. Let's get something straight, immediately. The market did not wake up today and decide crypto was bad, or that Bitcoin suddenly lost its purpose, or that TradFi magically became the adult in the room. That's cope. What happened today was pure leverage physics. And physics doesn't care about your narrative. Let's face it, everyone saw that CPI print. 2.7% headline, 2.6% core. Soft enough to spark hope, clean enough to invite confidence. And the second it hit the tape, leverage started piling up. Not slowly, not cautiously, instantly. Perpetuals lit up, funding flipped, open interest climbed. Because traders didn't say, okay, maybe risk is improving. They said, this is it, full send. They front ran the pivot. They chased the bounce. They levered the idea instead of waiting for confirmation. And that's where this turns ugly. Because crypto is where leverage lives, 24/7, perpetuals, thin books, fast money. So when liquidity tightens even a little, crypto doesn't get a warning shot. It gets margin called. That's exactly what today was. Perpetual longs got flushed. Open interest got wiped. Funding reset hard. And once that process starts, price disconnects from reality. Good news doesn't matter. Scarcity doesn't matter. Conviction doesn't matter. The liquidation engine sells because it has to, not because it wants to. That's why people were screaming. Why is price down when nothing changed? Because nothing changed fundamentally, but everything changed mechanically. Now here's where most people really expose themselves. They pull up on-chain charts and start reciting comfort phrases. Exchange reserves are low. Supply shock is building. Whales are accumulating. All true, and completely useless in the middle of a leverage flush, because scarcity is a background condition, not a circuit breaker. Scarcity does not stop forced selling. It only determines what happens after forced selling is finished. That distinction matters more than anything else tonight. When a trader is over-levered, they don't get to negotiate with the market. They don't get to say, actually, fundamentals are strong. I'd like to hold. They don't get to point at charts. They don't get to cite on-chain metrics. They get liquidated, automatically, indifferently, without debate. That's how leverage works. And this is the part people keep missing. The seller today was not coins. The seller was contracts. Paper exposure being vaporized. That's why you didn't see coins rushing onto exchanges. That's why reserves stayed low. That's why whale accumulation headlines didn't stop price. Because the selling pressure wasn't coming from holders. It was coming from margin engines closing positions. And once those engines turn on, they sell into whatever liquidity exists. Thin books don't absorb that smoothly. They gap. Small pushes turn into waterfalls. Stops chain react. Price disconnects from logic. Not because the asset is weak, but because the market structure is fragile. This is why price can fall in a supply-constrained market. Scarcity doesn't protect you during the fire. It only determines how violent the snapback can be once the fire burns out. So if you were pointing at low exchange balances today and wondering why price didn't care, now you know. Supply didn't fail you, leverage did. Now let's talk about XRP, because this is where people lose their composure. XRP didn't get hit because the thesis broke. XRP got hit because structure does not care about your feelings. And before anyone twists this, we like the asset. We do see a future here. But liking an asset does not mean pretending price action is something it isn't. Let's deal in facts. Over the last 48 hours, XRP broke below $2, a level it had defended for months. It slid from $1.98 to $1.79. That $2 level is no longer support. It's resistance. That matters. Now, here's where people short circuit, because the data underneath is screaming the opposite story. 30 consecutive days of ETF inflows, nearly $1 billion absorbed quietly. Institutional custody holding roughly 478 million XRP, about 1% of circulating supply. Exchange supply down 45% in 60 days. 1.35 billion XRP removed from exchanges. 800 million XRP moved into cold storage just this month. Whales accumulated 340 million XRP since September. Large wallets added more than 90 million XRP since mid-November. Take or buy dominance confirms absorption into weakness. So let's ask the uncomfortable question. If all of that is true, why is price still getting smoked? Because none of that buying is happening where price is set. Whales are not bidding spot. ETFs are not slamming order books. Institutions are not chasing green candles. They're buying off exchange, through custody, through OTC, through creation and redemption. That removes supply, but it does not defend price during a risk-off, leverage-driven tape. Now add the real accelerant, leverage. Earlier this month, XRP funding spiked plus 360%. That's not confidence. That's arrogance. Too many traders crowded the same trade. Over-levered longs got annihilated. Funding collapsed to negative 20%, a rare, violent flip. Open interest fell from $3.2 billion to $2.8 billion. That's not strength leaving. That's tourists leaving. And when leverage exits a thin market, price doesn't drift lower. It gaps. Thin order books plus stop losses equal cascades. $2 broke, stops fired. XRP slid straight through, not because XRP failed, but because XRP trades as beta when macro turns ugly. Bitcoin weak, XRP cannot decouple. Macro risk off, XRP gets dragged. That's not a flaw, that's reality. Now here's where we separate adults from cope merchants. ISO compliance does not protect price. ETF inflows do not stop margin calls. Exchange supply shocks make price more volatile short term, not safer. Scarcity is a setup, not a shield. And yes, the supply shock narrative around XRP has real substance. Large wallets are accumulating. Exchange float is collapsing. Ownership is consolidating quietly. That's not fake. That's not Twitter fantasy. But supply shocks don't pay you during deleveraging. They pay you after leverage is dead and liquidity stabilizes. Right now, XRP is stuck in the worst possible window. Strong fundamentals, thin liquidity, macro deleveraging. That combination hurts first. If the $1.80 zone reclaims and leverage continues to clear, the supply shock everyone keeps talking about finally has room to work. If it doesn't, price can go lower before it gets better. That's not bearish, that's disciplined. So let's be crystal clear where we stand. We like the asset. We understand the long-term plumbing case. We see a future where regulated settlement rails matter. But we do not confuse long-term conviction with short-term price protection. XRP is being accumulated in the dark while being sold in the light. And until leverage finishes burning off, price will not reflect fundamentals, no matter how loud the narrative gets. That's the truth. And truth is the only edge that lasts. Now zoom out, because XRP wasn't alone in this. What happened to XRP only makes sense once you understand what happened in traditional finance. A lot of people looked at the tape and said, crypto got wrecked, but TradFi did fine. That's a surface level take. TradFi didn't rally. TradFi rotated. And that difference is everything. While crypto was getting hit by forced liquidations, capital inside equities didn't panic and run for the exits. It repositioned out of high beta growth, out of AI and tech, out of anything that depends on cheap money and perfect conditions, and into defense, utilities, consumer staples, dividend payers, the most boring, cash flow reliable corners of the market. That's not optimism. That's survival instinct. The NASDAQ rolled over. AI names cracked. Oracle sold. Nvidia swept. Meanwhile, the Dow and parts of the S&P held together. Not because the economy is strong, but because money hid in places that don't die first in a slowdown. That's why the average viewer got confused. They saw green on an index and assumed risk on. Wrong. This was capital ducking for cover. Now let's talk about the real trigger underneath all of it: liquidity. The Federal Reserve halted quantitative tightening. On paper, people hear that and think, bullish, money printer. That's amateur thinking. The market heard something very different. The system is tight enough that we can't keep draining it. The Fed doesn't stop QT because things are great. They stop QT because the plumbing is starting to creak. And when the Fed blinks like that, professionals don't celebrate. They pull risk. That's why leverage got wiped in crypto. That's why tech sold off. That's why capital rotated into defensives and hard assets. Crypto felt it first because crypto is the most levered, most liquid, 24/7 market on Earth. It's the shock absorber. TradFi didn't avoid the stress. It just absorbed it more selectively. And here's the part that ties this directly back to XRP and the rest of crypto. Bitcoin and crypto are now treated by institutions as liquidity proxies for tech. When AI stocks wobble, algorithms don't wait for the stock market to open. They sell crypto. Not because crypto failed, not because the thesis broke, because crypto is always open, always liquid, and easy to hit. Same trade, different wrapper. If you want to see where money actually went, look at the scoreboard. Gold held near record highs. Platinum ripped. Utilities and staples saw aggressive inflows. Oil collapsed. A classic deflationary signal. That's not bullish behavior. That's capital climbing the safety ladder. First, sell crypto. Then sell tech. Then sell cyclical growth. Then hide in defensives and metals. That's late cycle behavior. That's capital preparing for a slowdown, not a party. So no, TradFi didn't win. TradFi hid better. Crypto didn't lose relevance. It got used as the pressure valve to flush leverage and reset positioning. And once you understand that, the divergence stops looking confusing. It starts looking inevitable.
Now let's bring this home. Tonight wasn't about calling tops or bottoms. It wasn't about hype. And it definitely wasn't about coping. This chapter was about mechanics. We watched leverage get punished. We watched scarcity fail to protect price in the short term. We watched XRP get hit despite strong fundamentals and real accumulation. And we watched TradFi do what it always does late cycle: rotate, hide, and survive. Nothing broke. What happened was positioning got exposed. Crypto didn't lose relevance. It absorbed stress first. XRP didn't lose its future. It got dragged by structure and leverage while ownership consolidated quietly underneath. TradFi didn't rally. It moved capital into defense and hard assets because liquidity is tight and confidence is fragile. This is not the end of anything. It's a transition phase, a chapter where excess gets burned off, where weak hands get shaken out, and where long-term setups are built in uncomfortable conditions. That's the reality of markets at this stage. Before we shut it down, quick housekeeping. Head over to the website. It's live, it's free, and yes, we know it needs love. We're actively upgrading it, tightening the flow, improving the layout, and building something that matches the level of analysis you're getting here. That's coming soon. If this helped you think more clearly tonight, smash the like, hit follow, and share this with someone who's confused, emotional, or about to make a bad decision. We're building this garage one chapter at a time, with discipline, context, and no bullshit. Same standards, same intensity, engines hot, safety off. Let it rip.